Hey traders, welcome back to the Com Lucro channel. Be honest, how many times have you drawn Fibonacci on your chart, watched price stall right at a level, and had no idea why? Today, in our Technical Analysis for Day Traders course, we're going to fix that. By the end of this lesson, you'll know how to use Fibonacci retracement and extension levels to spot real areas of support and resistance, set clear price targets, and sharpen your entries and exits, with structure, not guesswork. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Before we look at any charts, let's meet the man behind the math. Leonardo Fibonacci was an Italian mathematician from the 12th century who introduced the Fibonacci sequence to Western mathematics, a simple idea that would go on to echo through nature, art, and eventually the markets. The sequence starts with 0 and 1, and every number after that is just the sum of the two before it. 0, 1, 1, 2, 3, 5, 8, and on it grows. That same pattern shows up everywhere, in seashells, in flowers, in galaxies, and, as traders discovered, in financial markets as well. Here's why it matters to us. As the numbers grow larger, the ratio between them settles close to 1.618, the golden ratio, along with its inverse, 0.618. In trading, these two numbers become the backbone of the levels we use to anticipate where the market may pause, react, or change direction. When we apply these ratios to price, we get the retracement levels, 38.2%, 50%, and 61.8%. They estimate how much of a previous move the market might give back before continuing its trend. And they come straight from the sequence. 61.8% is one number divided by the next, like 89 divided by 144, while 38.2% is a number divided by the one two places ahead, such as 55 divided by 144. Beyond retracements, we use Fibonacci extensions to project targets once a trend is running. The key levels are 127.2%, a more conservative zone, often used for early profit taking, 161.8%, the golden ratio extension, and the main target for strong trends, 200%, a full doubling of the original move, and a common psychological target, and 261.8%, an aggressive target reserved for exceptionally strong trends. Now, let's jump straight into the strategy and see how it can sharpen your trading with real clarity and confidence. We'll start with the Fibonacci retracement. Open your chart on TradingView and grab the retracement tool. For bullish moves, connect the low to the high, keeping 100% at the starting point and 0% at the end. For bearish moves, simply flip it, 100% at the top, 0% at the bottom. Once it's drawn, open the settings so we can clean the tool up for sharper analysis. First, extend the lines to the right so they stay visible as the chart develops. Next, uncheck every unnecessary level and keep only the ones that matter. 38.2%, 50%, and 61.8%, your key retracement zones. Turn off the background shading to declutter the chart, and hide the price values to keep your focus where it belongs. Finally, under the level section, set the display to percent, so each level reads as a percentage. This setup strips the chart down to what counts, putting the most critical retracement areas front and center. But before we go further, it's worth hearing from someone who's traded for decades. David Paul shares a powerful insight on why keeping things simple and staying consistent is what really pays off.
When I started to trade really in 1982, I really didn't know that much, and I found that things went exceptionally well. Now, 2 or 3 years into the process, I found myself starting to make mistakes. When I started, I knew nothing. By 1984, 1985, I was a guru. I'd been on courses, I read the books. I now had something to protect. And I started to make mistakes in not cutting losers quickly. I started to make mistakes in not adding to winners. And I've seen this so many times over the years where people who start to trade do exceptionally well. They know absolutely nothing. They follow some fairly simple trend following rules and they do well. Then all of a sudden they become experts and now they've got something to protect. Ego comes in, it starts to build, it starts to build, it starts to build. You've now got something to protect. And I found that unfortunately, the more you know, at times the more difficult it is.
His point is clear. Even advanced tools like Fibonacci work best when paired with discipline and simplicity. Next, let's set up the Fibonacci extension tool for precise, effective analysis in TradingView. To do it, select the Fibonacci extension tool and mark 3 points: the start of the move, the end of the move, and the end of the retracement. For bullish trends, go from the low to the high. For bearish trends, simply reverse it. Once it's drawn, open the settings and adjust them for clarity. First, extend the lines to the right so they're easy to track as price evolves. Next, strip out the unnecessary levels and focus only on the key ones: 100%, 161.8%, 200%, and 261.8%. Turn off the background shading to keep the chart clean and focused, and hide the price values to cut out distractions. Finally, under the level section, switch to percent so the extension levels read as percentages. Now, let's read the market structure. Right now, it's in a downtrend, so we'll wait for a CHoCH to signal a possible shift before we even think about buying. As you can see, I'm marking the lower highs, LH, and lower lows, LL, on the chart, along with the descending trend line that highlights the bearish momentum. I'm also pinpointing where a possible CHoCH might form, a critical area where the market could hint at a reversal or a change in sentiment. Once the CHoCH is confirmed, the next step is to draw the Fibonacci retracement to map potential trade levels that align with the new market structure. By following this method, we keep a structured, disciplined approach to spotting high probability setups while we wait for the trend shift to confirm. In the next step, once the CHoCH confirms a possible shift from a downtrend to an uptrend, I'll draw the Fibonacci retracement directly on the chart. This is essential for mapping the key levels we'll use to plan potential entries and exits. Keep in mind that the retracement isn't fixed. It has to be adjusted as the chart evolves. After the CHoCH, price keeps moving and prints a higher high, which means we recalibrate the tool to reflect the new structure. That adjustment keeps our levels accurate and aligned with the latest move, pointing us to the most relevant zones for trade opportunities. By keeping the retracement updated, we hold on to precision and adaptability, two things you can't trade without when conditions keep changing. Now let's put the strategy rules to work and execute the retracement trade with precision. The key is patience. We wait for price to close below the 61.8% retracement level. Once it does, we watch for the very next candle to close back above it. And when that happens, that's our signal to open a buy. To set the target, we turn to the Fibonacci extension tool. Drawing it is simple. Connect below to the high of the move, then drop the third point at the retracement level. That reveals the key extension levels and points us straight to the ideal target zones. For this strategy, the stop loss sits at the 100% retracement level, a clean, clear line for risk management. And the target is the 100% level of the Fibonacci extension, giving us a precise goal for the trade. As you can see on the chart, this setup delivers a winning trade with a risk-to-reward ratio of 1.83 to 1, an excellent opportunity. By following these steps with discipline, every trade rests on solid structure and logic, maximizing the potential for consistent, profitable results. This one shows the real power of combining Fibonacci tools with precise market structure analysis. That's our edge in the market. Now, with the market clearly signaling a change in direction, it's time to adjust our approach and align with the newly established bullish trend. Following the CHoCH and BOS, which confirmed the shift in structure from bearish to bullish, our focus moves to fresh buying opportunities. The first step is to clear the old bearish markings, like LH and LL, since they no longer apply in this new context. Next, we redraw the structure to reflect the bullish trend, marking the highs, lows, higher highs, HH, and higher lows, HL. This keeps our read of the market's direction clear and accurate, making it far easier to spot setups that line up with the trend. By updating the chart this way, we keep everything clean and precise, staying in sync with the bullish market and confidently hunting the next high probability opportunity. We then reposition the Fibonacci retracement, anchoring it from the most recent higher low and updating the high point as price evolves. And just as before, price closes below the 61.8% level, then closes back above it on the next candle, signaling another chance to enter a buy. Now, one important point. After we enter, price prints a lower low than the previous one. It doesn't hit our stop loss, which stays at the 100% retracement level, but it does force us to adjust the Fibonacci extension. As a result, the target shifts too, bringing the risk-to-reward ratio down from 1.9 to 1 to 1.72 to 1. Even so, it's still an excellent risk-to-reward trade. And just like the first one, this setup closes as another winning trade, proof of how well this strategy works when you execute it with discipline and precision. Before we wrap up, here's what we want to make absolutely clear at ComLucro. Fibonacci levels are not magic numbers. They don't work because of some hidden law of nature, and no ratio, however precise, can predict the market on its own. What actually gives these levels their power is far simpler. Thousands of traders and major institutions are watching the very same 61.8% or 161.8%, and they position their orders around it. The level matters because the crowd makes it matter. It becomes a shared reference point, a place where buyers and sellers meet again and again. And there's a deeper logic to where they cluster, but it only means something once you've chosen a direction. Say you're bullish, trading with the trend. Through a smart money lens, a deep pullback into the 61.8% retracement reads as a discount, a good place to buy in the direction you already favor, while a stretched extension, like the 100% or 200%, becomes premium, where price has run far and built real profit, the natural spot to sell what you bought and take money off the table. Discount and premium only make sense relative to your bias. Flip the trend, and they flip with it. That's the discount and premium thinking we break down step by step in our Smart Money Concepts course. That's exactly why Fibonacci should never be your only reason to enter a trade. Treat it as one reference inside a broader plan, always combined with price action, volume, market structure, and the overall context you're trading in. Used that way, these levels stop being a prediction and become a map. They show you where price is likely to react, so you can prepare instead of guess. Because in the end, it isn't Fibonacci that moves the market. It's the people behind the trades, and your edge comes from reading what they're likely to do next. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.